Hey y'all, so today's video is going to be all about the differences between the standard deduction and itemized deductions and which option is better. Now, taxpayers in the US do have the option to choose between the standard deduction or itemized deductions, but it's up to you to decide which is the better option for you. And that's why today's video, I'll make it as educational as possible to be able to educate you on which option you should choose. This video is only educational. Nothing that I say in this video is tax advice, financial advice, or legal advice. And my name is Daphne. I am a tax preparer here in the southeast part of the United States. I handle tax preparation, bookkeeping, quarterly filings for individuals and small businesses in the southeast part of the United States. So if you're interested, just go ahead, check the description down below, and I'm happy to help you. All right, so today's concept, like I said, is the standard deduction versus itemized deduction. These are the two main ways that you can reduce your taxable income whenever you file your taxes on your tax return. I'll explain each deduction, what each deduction means, how it applies to you, be as clear as possible with some examples, and compare them side by side. I'll also be going over the latest changes in 2025 when you're filing for 2026 for the 2025 tax year, the inflation adjustments and law updates for the 2026 tax year that is coming up throughout the 2026 tax year. And let's go ahead and get started. The standard deduction is a flat fixed rate number. It's a flat fixed dollar amount that the IRS provides and lets you subtract from your adjusted gross income to calculate your taxable income. So you take your adjusted gross income minus your standard deduction, and then you get your taxable income. Your adjusted gross income is basically your total income. This is wages, business earnings, and investment income minus above the line adjustments like student loan interest, alimony that was paid, or self-employment tax. With the standard deduction, you don't have to prove or track lots of separate expenses. So if you're a single filer, you get a certain standard deduction. If you're a head of household, you get another standard deduction. It just depends on the filing status that you get. The standard deduction is usually the easiest options that most American taxpayers choose. Is it the best option? It depends based off of different circumstances that I'll talk about soon. It's the easiest option because there's minimum record keeping. You cannot claim both the standard deduction and itemized deductions in the same year. You must choose one. If you don't have many large deductible expenses, this is usually a good option. The standard deduction will almost always save you time and might save you the most money. For 2025, the tax return that you'll be filing in 2026, starting January 1st, the standard deduction amounts are $15,750 for single filers and also married people that are filing separate. Married people that file separate get the same standard deduction as single filers. $23,625 is for head of households. $31,500 is for married people that are filing jointly. Here's where your standard deduction can increase. If you are over the age of 65 years old or you are blind, you get an extra standard deduction. In 2025, single and head of household filers get an extra $2,000 per condition. $2,000 if you're over the age of 65 and $2,000 if you are blind. Married couples that are filing jointly get an extra $1,600 per condition per qualifying spouse. So if the spouse is over the age of 65, they get an extra $1,600, and if they are blind, they also get an extra $1,600. The standard deduction does increase slightly every year with inflation. For 2026, which is the tax return that will be filed in January 1st, 2027, the updated standard deduction amount will be $16,100 for single filers or married people that are filing separately, $24,150 for head of household filers, and $32,200 for married people that are filing jointly. Now, an extra deduction for the age that is over 65 and blindness rises too. So for 2026, singles and head of households get an extra $2,050, while married couples that are filing jointly get an extra $1,600 per condition per person. All right, now what is itemized deductions? We've discussed how standard deductions is a flat rate number that occurs years based off of your filing status. Then you add per condition, whether you're over the age of 65, you get an extra add-on. And if you are blind, you also get an extra add-on. But what is the itemized deduction? Itemized deductions are specific expenses the tax law lets you deduct individually. Instead of you taking on the full-on standard deduction without having to do much work, the itemized deduction, you have to deduct individual expenses. You list each expense like mortgage interest, state and local taxes, major charitable contributions, and large medical expenses. This all goes on Schedule A on Form 1040. And yes, you do have to be as accurate as possible. For example, tracking your expenses throughout the year of your mortgage interest, charitable contributions that you contributed to, and larger medical expenses and what that totals up to. If your total itemized deductions are greater than the standard deduction for your filing status, it's beneficial for you to take on the itemized deduction over the standard deduction. Otherwise, if the standard deduction is higher, it's better for you to take on the standard deduction. Now, there are some definitions that I do want to clarify. For example, mortgage interest. Mortgage interest is the interest that you paid on a qualified home loan. State and local taxes, they're also called SALT. They are property taxes plus income or sales tax, but with a deduction cap. Charitable contributions, they are gifts that go to qualified charities that must have documentation. Medical expenses can only be deducted if they exceed a set threshold of your AGI, usually 7.5%. There have been recent laws such as the 2025 One Big Beautiful Bill Act, where this has changed the cap on the SALT deduction, which is the state and local taxes deduction. For tax years 2025 and 2026, you may deduct up to $12,000 combined state and local taxes, $6,000 if single or married filing separately. Certain other itemized deductions remain limited or suspended, including miscellaneous job expenses through at least 2026. So these are new changes that have happened, most of which you can find just searching up the Schedule A. Let's say that you're married filing jointly in 2026, you own a home and you paid $13,000 in mortgage interest, $9,000 in property taxes, $8,000 in state income tax, and donated $5,000 to charity. Your total itemized deduction would total up to $35,000. Your total itemized deduction would potentially reach $35,000. I say potentially because there are limits, there are caps according to each one of these categories. Now, if you compare this to the standard deduction for 2026, which is $32,200 for married people that are filing jointly, since $35,000 is higher than $32,000, it would make more sense for you to itemize than to take on the standard deduction. The reason for this is because if you itemized, you would get a lower taxable income, paying less tax. Now, if your total itemized amounts are less than the standard deduction, pick the standard deduction for simplicity and greater savings. The standard deduction is simple. There's no need for receipts, there's no expenses tracking, there's no special calculations. Itemized deductions go through more record keeping, forms from mortgage lenders, property tax bills, receipts from charitable gifts, and medical bill documentation. Generally, taxpayers should use the standard deduction unless the itemized deductions, which meet the IRS qualifications, total more than the standard deduction for their filing status. The standard deduction amounts are rising, which is making it harder for most people to itemize deductions to beat the standard deduction. State and local caps and other limits introduced in recent laws do remain, so high state and local taxes or major medical expenses may still make itemizing worth in certain situations. Let's say you are head of household in 2026 with $9,000 in mortgage interest, $4,500 in property taxes, $3,500 in state income tax, and $2,500 in charitable donations. This would total up to $19,500, and if you compare that to the head of household standard deduction, which is $24,150 in 2026, the standard deduction now wins. So itemizing wouldn't make any sense. Every year, the IRS adjusts deductions for inflation. If you're over the age of 65 or blind, your extra standard deduction rises a bit every year. $2,050 for singles and head of households, and $1,650 for married couples in 2026. If you think that you might be itemizing, make sure to maintain good records, mortgage interest forms, tax bills, receipts, documentation of medical expenses, expenses, and charitable donations. If you take the standard deduction, record keeping is more straightforward, but always keep copies of your tax return and related paperwork. Also, if you do expect major changes like buying a home, high medical expenses, large charitable gifts, moving to a higher tax state, consider tax planning to maximize your tax deduction in the year, because this is going to have the greatest impact. Since future deduction amounts are published, you can go ahead and plan ahead for 2026, because now we have the standard deduction amounts 100. So if you did find this video helpful, just go ahead and subscribe. I would love to be able to educate you as best as I can, continuing with these videos. And also, I will leave my information down below if you're interested in me helping you out this year in regards to taxes. If you're an individual or business owner, I will say the best approach is to estimate your likely income and expenses early in the year. This will help you a lot. Track your major deductible expenses at all time, and me as a tax preparer will make sure to compare both for you to see which one is the best option for you.